So in this video, we're going to be examining and evaluating foreign direct investment. Foreign direct investment is a very controversial issue in the world right now, and that's reflected in your curriculum for A-level or IB, in particular the development economics section of the course. So today I'm going to be looking at this issue as if we were writing an essay on it, or an IA, or one of the evaluation questions in the final exam. Okay, so as usual, the way I always advise students to write essays is through the formula DD. Okay, now DD stands for define, example, explanation, diagram, explanation, and finally evaluation. Okay, and that's absolutely key to getting full marks in IB or A-level economics. So let's crack on with our first part of your essay, which will be your definitions. So to define foreign direct investment. Now, foreign direct investment is when multinational corporations invest in business operations in another country. For example, Apple is an American corporation. Okay, it says that on your phone and on your computer. However, we all know that your phone and your computer is not only made in America. They would both be extremely expensive if that was the case. So to cut costs, Apple has production facilities all around the world, such as most famously in China. Now, there's many reasons why corporations engage in FDI, and now I'll explain some of those reasons why they do this. So number one is production costs. Now, to produce a good in the Europe, the UK, or the US, or developed countries is extremely expensive. Now, that could be due to wage levels, or it could be due to land costs, etc., etc. And developing countries, of course, typically have much lower wages. So multinational corporations are attracted to those countries to use their human capital. Okay, number two is economies of scale. Now, you'll know this from your micro section of the course. That's when, as the company gets larger and larger and opens up into new markets, the costs of producing each additional good is reduced. Okay, so next is natural resources. Now, we know many natural resources can only be found in certain countries in the world. Oil, for example, can only be found in certain countries. Chocolate, coffee, and to use the mobile phone example again, coltan. Now, coltan is extracted from mines in the Congo. It can't be found anywhere else. So multinational corporations go to these countries and extract their minerals to use them in their products to be sold later. Now, with that, of course, is increased revenues. So with the decrease in production costs, economies of scale, etc., etc., the companies themselves will increase revenue. So if you think about the basics economics, that we're all rational individuals acting in our own self-interest. If corporations are doing the same, then they will engage in foreign direct investment if it's in their own best interest, aka making a profit. Related to that is to avoid trade barriers, the next reason. So many multinational corporations will open production facilities and create goods in countries just to avoid the high tariffs imposed by other countries. For example, Volkswagen has production facilities in India and Indonesia precisely for that reason, to avoid the WTO tariffs on the European Union. Next is logistics. So if I am a corporation and I want to sell to the market in Asia, it will be much cheaper for me to build a factory in, say, Indonesia. Say if I want to target the Asian market, I should build my factories in developing countries in Asia. This would cut down the costs of transports and many other costs incurred. Okay, so finally, for the corporation, there are many financial incentives offered by governments for them to relocate or build production facilities in their country. And this can take the form of subsidies, corporate tax breaks, and many other various techniques the government can use, like grants, cheaper lands, all these kind of things. They're so numerous that, yeah, I can't talk about them all in this video. Okay, so that's why. That's why multinational corporations engage in FDI, and that's an explanation of why this is the case. So next we'll have a look at why is it attractive for developing countries to get FDI. Okay, and this can also be used as the pros or the benefits of foreign direct investment. So first of all, FDI is often related to growth rates. And we can see that in a couple of diagrams. So first we've got the long run aggregate supply diagram, which can be done in the Keynesianist or the neoclassical way. Both say the same thing. With the increase in foreign direct investment, you will increase incomes, increase productivity, and increase technology, and therefore there will be a shift in the long run aggregate supply. Now you can also show this in the PPC diagram, the production possibilities curve, and that shows a shift in the production of two goods, consumer goods and capital goods. That's because they are more efficient and more effective in producing those things. Okay, so that leads us on to another point, is that many of these developing countries are experiencing the poverty cycle. Now the poverty cycle is when low incomes lead to low savings, which then leads to low investment, and then leads to low economic growth, and background to low incomes again. Now, the introduction of FDI has often been seen as a way to break that cycle and encourage what's called the Harrod-Domar model. Now, the Harrod-Domar is like the reverse of the poverty cycle, which is increased savings, increased investment, increased capital stock, increased outputs, increased income, and therefore increased savings again. Okay, so the poverty cycle is like a spiral downwards. The Harrod-Domar model is like a spiral upwards. So also there's the next issue of the pros is technology transfer. Now, technology transfer has been key in the development of many, many economies around the world, particularly the Asian tiger economies. So even if you think about Japan, like how they developed and how they used technology after the Second World War, and how they were able to improve on that technology and develop at a very fast rate. Foreign direct investment were key in all of this. And technology transfer in particular was key. So with technology transfer, you get an increase in infrastructure, you get an increase in education, you get an increase in all of these things that improve development. Okay, now also with that, you get an increase in tax revenues. So the more FDI you have, the more taxes they will pay to your government. And that will help the government invest in merit goods like healthcare and further education and further improve living standards. Now, also another diagram you can use is the positive externalities of production diagram. So say, for example, a company or a country invests in building a power plant. Now that power plant will have massive social benefits to the surrounding area. The introduction of electricity to many of these communities, you'll have to build roads. All of these are social benefits that benefit a third party. So you can draw that diagram if you're talking about FDI in some cases. So next we'll look at the cons or the negatives related to FDI. First of all, I know I just talked about positive externalities, which are quite common, the positive spillover effects on the economy, but there could also be negative externalities of production. That would be where the social costs exceed the private costs. And the reasons for that would be if the company was extracting precious minerals or engaging in environmentally damaging activities, such as many multinational corporations will go to a country because of those lack of regulations that we have in developed countries. They will exploit the environment and they will cause negative externalities and costs on the third party. The second point is that profits from these activities will often be, well, most of the time, be repatriated to their home countries. They're not reinvested within the country, which may not be in that country's best interest. And also, that many times the multinational corporations, the highly skilled or management segment of the company, will be from their home country. They won't train up or employ people in the host country. And that means that many of the low skill labour will be taken from the developing country and um, not develop to highly skilled professions. Also, the multinational corporations can be argued to have way too much power nowadays. They can easily move their production facilities from one country to another. That means that they can play off governments against each other, creating a kind of race to the bottom. So that means that countries will offer multinational corporations a tax break, and another country will offer them a larger tax break, and then another country will offer them a larger tax break. So the multinational corporation is able to kind of play this game of countries competing against each other, and they can do that even within the United States. They do that with New York versus New Jersey or any of the other states. It's a really interesting topic. So you can do some research into that one. And the last one is that the multinational corporations will be more vulnerable to external shocks. So, say for example, you've got a Japanese corporation and they have a production facility in Thailand, for example. This is true for many semiconductors, many electronic goods. Now, what happens if there's a recession in Japan? Now, if there's a recession in Japan, then there's going to be less foreign direct investment into Thailand. And therefore, the Thai economy will be damaged by an economic situation that's in another country. Okay, so here's some of the key arguments for and against foreign direct investment. And I just quickly ran through the diagrams because I know you probably know them already by this point of the course. So hopefully that helps you with foreign direct investment. Okay, thank you very much. Bye.